Welcome to This Week in Money. I'm Jim Goddard. Today, a special edition of the show featuring a conversation between WallStreetWindow.com's trader Mike Swanson with CIBC Wood Gundy investment advisor Ross Clark about how to take advantage of any market. We hear from Mike Swanson and Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
Our special edition of This Week in Money features a conversation between trader Mike Swanson from WallStreetWindow.com and Ross Clark, investment advisor with CIBC Wood Gundy. They discuss how to take advantage of any market. We'll start the show with our guests telling us a little bit about themselves and how to contact them. Then it's full contact when it comes to talking about the markets.
Thank you. Well, this is Ross Clark in Vancouver, and I have on the line with me Mike Swanson from WallStreetWindow.com. And Mike is clearly not a stranger to this radio show, and we welcome him aboard.
Yeah, thanks for having me. It's great to talk with you and have an opportunity to talk to everyone else.
Right. Well, just one piece of background. I'm an investment advisor with CIBC Wood Gundy here in Vancouver. And if anybody wants to get a hold of me later on, my contact information is ross.clark@cibc.ca, or you can get me directly at 604-661-7759. And Mike, if you'd like to maybe let us know about your contacts and just in general the services that your website provides. I know you've got Power Investor and other items that are out there that people will have an interest in.
Yeah, sure. My website's wallstreetwindow.com. It's all one word. And my background is I've been investing around the stock market now since the late 90s. And I ran a small hedge fund for a couple of years, about 10 years ago, and kind of went into semi-retirement and started this website again. But people can go to the site. I do have a pay advisory service, but if people want to pay a little bit amount of money, they can just get a book that's also available on the site too, to get more an idea of my ideas and so forth.
Yeah. Well, I've seen your material off and on over the years. Quite enjoyed it. I've been around a little bit longer even than you. The early 1980s, I was trading a lot of the futures markets, the gold and silver market back in those days, pretty actively, and transitioned away a lot from commodities over the years, more into the equity side of the equation, but still have an affinity for the precious metals. So I quite enjoy the material that I see from you. And conceptually, I like the whole idea that you look at phases and stages that the market is in and that given sectors are in, and then how you take that and move then to making recommendations. And I started off the first people that I learned from Justin Mamus and Stan Weinstein. Their stage analysis, very, right along the lines of what you're doing, and maybe if you could get people a little bit of a feel for, what that aspect of it looks like as far as your bottom line work. I know you have fundamental background that you like to look for valuations, but from a technical perspective, maybe get a feel for what you look for.
Yeah, sure. And I used, like you were saying, the stage analysis, which I learned it from Stan Weinstein's book, and that book was written right after the '87 market crash. But actually, there's another book written in the '60s. I've got it somewhere, but the author slips my mind. But it's, as far as I know, it's the first book that really has these ideas in it, and you can tell Stan Weinstein was inspired by that, and then I kind of used Stan Weinstein's ideas, or was inspired by them a long time ago. And as you trade and invest over time, you incorporate your own ideas or things you learn from other people and kind of grow into your own type of investor. But the bottom line, though, is the overall idea, I think the real importance of this stage analysis concept is to align yourself with what the dominant trend is in the stock market. And, the easiest way to try to identify that is just look at the long-term 150 and 200-day moving averages. And if those are climbing, they tend to act as support in a bull market. And as long as they're sloping up, it's easy to say, oh, we're in a bull market. And that's the case, with the S&P 500 and the NASDAQ at the moment. And then in the bear market, the opposite happens, as the moving averages slope down and act as resistance. So with gold, you can see that clearly happened, in 2012 and 2013. But one thing that happens, and I believe this is what's happening in both these markets, is between a bull and a bear market or vice versa, you get a stage of transition. And in the Weinstein's work, that's a topping market, and that could be what's going on in the U.S. stock market, and then gold is the opposite. And on a chart, these moving averages in both these instances tend to start to flatten out. In gold and the mining stocks, they're basically going sideways right now, which I think is a sign that the bear market actually ended last year and they're transitioning into a bull market. They are forming a base, and it's probably around 250 on the HUI as resistance. And if that's broken, I think we're in a new bull market. The same level is about 1,400 on gold. And I think to me, that's the story with gold and precious metals. I don't know what you see in that.
Well, I look at, both, I look at some seasonality factors. I look at this as a post-mania condition that we have, in that, the silver market topped out 3 years ago last month. The gold market just about, 4 months after that. And, I look at these manias when you have that exponential growth curve where gold and silver, and look at previous examples, and it doesn't even have to be the same market, because I tend to think that there's a lot of investor psychology that runs on this stuff, especially when you're hitting extremes. Not so much when you're in the slow, methodical trends, but once the extremes have been seen, that's when there's a lot of indicators that really kick up. And if I look at, the peak in the Dow in 29 and then 1932 bottom, you got about 3 years. You do the same thing in gold, 1980 to 82. You do the same thing in the the Nikkei, 89 down to 92. There's sort of this 28 to 36 month period there where you get it takes that long to get down and find a reasonable bottom and a place from which you can get some stability. So that's been my view that I've been looking at gold here for this, basically since last fall. And I know one of the characteristics I see in this is that, once you've had that that final spike low, and let's assume that was either last June or in December when it did the retest on the low of gold. First bounce back is to the 200-day moving average, and that seems to be fairly norm. Whether you want to deal with a fib number at 233 or something else, but that first bounce, I really like what we've seen here already. And then in my work, I see in those other examples that once you put in that good low, if you now don't give back more than 60% of that advance, that's how you basically create that tested low from which you can have the sustained move. I don't know if that fits into the type of thing that you'd be looking at.
Yeah, for sure. And one indicator I find useful for trying to identify these basing phases or bottoming phases are the 200-day Bollinger Bands, and they measure the long-term volatility in a market. And this is something I learned from, I can't remember the guy's name, but the thing about the Bollinger Bands is most people use short-term Bollinger Bands to day trade or do swing trades, this kind of business, like a 15-day Bollinger Band or 20-day Bollinger Band. But I like to use the 200-day Bollinger Bands to try to identify these larger trends. And what tends to happen is these bands are wide apart when there's a lot of volatility in the market. So in 2008, when the U.S. stock market crashed, those bands just expanded like crazy. But then after a period of 8 to 12 months of going sideways, they contract very narrow. That's what's going on with the mining stocks. They're about as narrow as they can get. And that suggests to me that if the gold stocks and gold itself get to the 200-day, the upper 200-day Bollinger Band and break through it, that would be a suggestion to me that this bottoming is complete and we're in a full-blown brand new bull market. I have trouble, though, these bands don't seem to work as well, or you don't get the same type of activity to try to identify long-term tops. So I've got, big tops in the market actually, more difficult to identify just looking at price itself. You have to, I think, look more like at the general psychology as you're speaking of, and also what the sectors that make up a market are actually doing, because normally you see deterioration or less and less participation in the rallies as the bull market really matures. And
well, as we're seeing now, when you've got so many sectors that are not participating in the rally in the first half of this year.
Yeah, and that's something that has me, because I don't know if the word's bearish, but concerned about the U.S. stock market, and I think we could see a bear market if that continues. Before we started to speak, I checked and something. Let me see what the exact figures are right here. In the S&P 500, 211 of the 500 stocks are actually in the red year to date, with the retail stocks really getting clobbered. Stocks like Best Buy, Amazon, Whole Food Markets collapsed just yesterday, Staples, and on and on. And a lot of people use the advanced decline line to try to measure this stuff, but it can be misleading at times because it also includes funds and ETFs and all kinds of stuff.
Well, the whole makeup of the indices has changed so dramatically in the last 20 years. Not so much the indices, I would say, per se, but the number of vehicles on the exchanges. And when it used to be just operating companies, that was simple. Then the AD line in my mind, had a lot more significance than it does these days.
Mm-hmm. And then what I use, the software I use to analyze the stock market or try to look for investments and so forth is TC2000, put out by Warden Brothers. They advertise everywhere, so most people probably have heard of it if they're subscribing to trading stuff. But anyway, they break up the market into 239 what they call industry groups, or sectors and so forth, and half of them are actually in the red year to date. Now, in 2007 and 2000, the market topped out then in October 2007. These sectors weren't simply in the red. Half the market was below the 200-day moving average, and that's not the case now. So that suggests to me that we're not in, this isn't the start of a bear market next week or next month or whatever, but we're seeing signs of deterioration that if it continues and gets to the point where these things aren't just in the red, but below the moving averages, then I think people would be best to get out of the market.
Yeah. Well, it clearly looks like there's a lot of sector rotation going on. I mean, we take a look at the the value stocks versus growth, you take a look at the Russell 2000, the makeup of the two indices there, IWN and IWO. Clearly you can see the movement, even on a day-by-day basis. I mean, here today we got, this is Thursday, and I'm looking at Russell 2000 growth is down 1.3%. Value is down 0.75, and it's been pretty much that way through the last month or so, that growth, which had been a real driver on the upside, is giving up the ground. So what do we got? The Russell's, the 2000 sitting pretty much at the lows of the year. You got the S&P and the Dow flirting with all-time highs again today, and the Nasdaq right in the middle of the yearly trading range. So, definitely that huge sector rotation going on out there. And I think my thought is that when you are in, this being, I also take a look at us in terms of being a midterm year in terms of U.S. elections. And, first quarter tends to be good. Second and third tend to be choppy with a small downside bias. So, if I'm an institutional investor, and I want to be conservative for the middle part of the year, what have you done? Well, you've been moving away from your growth stocks into value, just so that even if it does give up ground, you're giving up less.
Yeah, that's a great move for anyone managing money that's doing that. Because you see, every day it seems like there's some technology stock that was hot and last year. It's just blowing up. Yesterday, Twitter exploded, and they're all like 17% drop or something.
well, even some names like Whole Foods joined the parade.
We'll have more with our trading experts Mike Swanson and Ross Clark next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to this special edition of This Week in Money. And our panel, Ross Clark from CIBC Wood Gundy and trader Mike Swanson from WallStreetWindow.com.
We were just, talking about sector rotation and what maybe is going on in the markets at this point. And, that then leads me to think about one of the biggest markets out there, which is the bond market. Basically, 10 to 20 times the size of the equity market. And, Mike, what are you seeing in bonds these days?
Well, I find the bond market right now actually to be the most interesting market, not in the sense that I necessarily want to buy it or do something with it myself, but the movements in that market are absolutely fascinating because, the news is that the Fed is reducing its quantitative easing program, which is purchasing treasury bonds. The economy is supposed to be picking up and doing better in the second half of the year. Supposedly, we had a slowdown because of poor weather, and that's gone. And the Fed is talking about, potentially raising the rates in a year from now or so. However, what's interesting is the bond market is evidently doesn't believe that, or something is going on, because bonds have been going up in value the past about 2 months. The 10-year and 20-year Treasury bonds have risen.
Yep.
The TLT ETF has broken out, and the rates have dropped. So I'm like, what does that really mean? I don't really know, but it seems to be a real trend.
Well, there's this whole perception that the public will have based upon the headlines that they've seen. And, last year the fear was, interest rates going to move up dramatically and quickly. Everybody got that mindset in place by the time we got through the summer and into the fall. And if we take a look at that TLT you're just mentioning, it bottomed in September. Tested the low in December, and it's up over 10% this year. Plus pick up a coupon along the way. And on the other side of the coin, there's your government item that's done well. The other side of the coin, the high yield products, which had been giving up very, very little ground when the tapering was announced a year ago. Looks as though they've had their best run. And, when I look at high yield versus high grade, clearly it's the same type of thing that we're seeing over in the equity market, where the money is moving to more and more secure items. Regardless of what you think about the government's ability to balance the budget and the fact that corporations are running better balance sheets, right now the money is moving towards that government paper. And my rule of thumb is follow the money. Well, your positions and my positions are small enough. That's really what we want to do.
Well, what do you think? Do you think it means anything that these bonds are going up in value like this?
Well,
what do you think the cause is?
Well, in terms of cause, to me, an economy that's still reasonably slow is what keeps interest rates down. It's the single best thing that could happen would be that the economy takes off and interest rates start to rise, and all of a sudden those who have to invest into fixed income products to get to have the ability to sustain, their retirements, and the life insurance companies to pay out benefits, etc. This is really what you want. We want a rising interest rate structure. Back in the early days when I came to the business, what you wanted was a rising interest rate market. That everybody's worried about it now, but in terms of cause and effect, to me, it's when you got a weak economy, that's when you have low rates. If this economy starts to take off, you're going to start to see some better rates. But it's been the most feeble start in 5 years off the bottom here in terms of what's happened. And I think that's what's there. I also look at it and say, I do a correlation of the JGBs, the Japanese government bonds, and the time frame after the top of the equity market there in '89, and then what happened in the ensuing years. And it wouldn't surprise me that this U.S. Market is maybe 40 basis points either side of here through the bulk of this year and into next year. Everybody wants to see big moves. They're looking for trends, but a lot of the time the market just goes sideways.
Yeah. Well, that's one of the things I think. Besides the bond market, we're talking about the gold market and the U.S. stock market. I think, in a way, that's what's going on in those two markets too. Whether you're bullish or bearish, or the listener or whatever, but I think those markets are really going sideways at the moment, and that's a tough type of environment to trade and make money in, because I think it's easy to get fooled. When something goes up, you think it's the start of a new bull market or some giant rally's coming, and then when something goes down, you think the end of the world's coming. In reality, neither is really happening.
Yeah. Well, that's where, back onto the gold and sort of looking at this post-bubble type of scenario we're into right now. And I think back to some of the years like 1985 when, we spent 15 months with gold trading in about a 7% trading range. Talk about chattering and, getting excited about breakouts that never happen. But what I see here, and so I take a look at the seasonal aspects of this in terms of, Ides of March is usually a turning point for the gold market, and when it's in a downtrend, you can expect the end of the quarter we'll see some selling pressure, which is what we had. You got to bounce into April, but I'm looking at May and early June as being really important for gold, because if it can retrace now better than 60% of the decline, so if it can get back through 1345, that's sort of my magic number I'm looking at. There isn't one instance back to 1970 where if you've had that April-May break, or March-April break, and you can turn the corner, then you will take out the high of the year. And you go back to all the way to 1970, and that thing is just so clear cut. So I'm kind of hoping that maybe we can do one last little, what I would call a spring of the support, that 1270, 1275 range. That has been so important to gold since last spring. I think we probably bounced off of that and had a lid on it maybe probably 10 or 12 times. And if we can just go down and take that out marginally and then turn the corner, that's so typical of a gold bottom. Just clean out the last of the weak longs and then get going. Then I think we got some legs, but I always look for the catalyst point. You never know what the news story will be. Hopefully it's not Ukraine, because those tend to be very short-lived. I would hope it's something that is a little different. But 1345, and I'd be pretty excited.
Yeah, it's interesting that you bring up that level on gold, because on last Sunday, not this Sunday, but anyway, at the beginning of this week, I was looking through the charts, and I thought if gold went through that level in the GDX went up, I think the level is 25. Basically the recent highs, that I think if that were to occur, that both would then attack the March highs, and then you're in a very bullish looking chart where you have the potential to break out of this stage 1 base and just take off. But Monday, instead, what happened was we gapped close to that resistance right on the open, and essentially it's come down off of it all the way back down to support. But I still think that's a really important level that you're mentioning, and if it's broken through, then I think it's going to be real good.
Yeah.
I was actually planning on buying if it happened. More.
Well, and I think, and the miners have been holding up reasonably well. I mean, it's just the opposite of what we saw back in 2011 when the miners just couldn't participate in the latter part of that rally. And, back, I think into, even the, December of last year when the silver stocks, in a particular, I've got two that I call the dogs. I won't mention the name on the air, but there've been, two of the senior silvers out there that just were weak all the way down for about 3 years. And in December, they finally started to hold as the silver market was making new lows, and they had like 30 and 40% moves off the bottom. So I'd like to see maybe the GDX and the Huey hold in here. If there was to be one that last little sort of clean out in gold and a reversal, if the miners could hold in, that would be a pretty good indicator.
One thing about investing and looking at any market is one thing I'm not sure the word is worry about, but everyone has experience in investing in some market somewhere, everyone listening. And my experience with gold was started in 2002. So I saw several big declines and then, rallies and so forth, crashes, practically two of them. And of course, trade the stock market and have gone through two big bear markets. But one thing that was different with this gold experience this time was that in the stock market and also the other gold drops that I had been through, these markets all recovered very quickly and bottomed very fast and went into new bull markets. There was no drawn out basing phase like there has been this time for gold. So that is something it took me a while to adjust to. I actually bought or tried to buy a couple of times last year before we get stopped out real quickly. And this time, I figured out, I'm going to hold more this time. But the point is that I want to make is that I think the U.S. stock market is also going to, whenever it has another market, we could easily see it enter a period of a 1 or 2 year base or something. That would be something that people have no experience of in the United States. We're used to the bear market ending and then making all our money back, and if it doesn't do that, I think a lot of that would be really cause a lot of people to stop investing or get very, very negative and bearish like they suppose evidently were in 1980 or 81.
Yeah, well, I mean, whether you have it as just a market that's been under dramatic pressure or a market that then just goes sideways. I mean, I lived through the 1994 market, and equity market just did absolutely nothing. And it's like we've been watching in gold here for the last year. It got itself a trading range, but can't seem to get any legs to do anything. And that's the frustration for investors who are looking to make just purely capital gains. Whereas if you've got a portfolio that's generating some income, 3, 4, 5%, or maybe you're up to some REITs and getting a little bit better than that, then you don't mind sitting on a stock that's just biding its time as long as it's giving you a decent return. But if you need the growth and that's what you're looking for, it's a very, very frustrating period.
Yeah, I just think, I'm not. There's a lot of doom and gloom arguments and people out there, and for a lot of people, just saying a bear market's possible is doom and gloom.
Yeah. Well, I know there's a lot out there who are calling, this big megaphone pattern, the broadening pattern since 2000, where you've had now 3 higher highs, and you've had a series of lower lows, back to the last one being in 2009, and saying that, we're going to go back down and take that out. And I look at it and say I've seen these broadening patterns many, many times before, and only a small percentage of them break down. And really the key is, and I'd like to see a correction at this point of the 15, maybe 20% variety in some of the issues, because that's a norm, and we've been so long without a decent correction. The Nasdaq, the work that I did, this is the longest run since the one into the 2000 peak without a decent correction in it. So this correction that's going on, I think is healthy. And if all we do, say in the S&P or in the Dow right now, is correct back towards those 2000 highs, and we hold, that could set you up for the next leg to the upside again. But, pauses are good. I mean, they're cleansing items. And to me, in a methodical trend, I'd like to see these small regular cleanouts. And in particular, if you're going to do it in the third year of a presidential term, it's usually a back-end loaded year. That fourth quarter and then into the first half of next year gets to be pretty exciting.
Well, what tends to happen in the fourth year of a presidential cycle year?
The fifth year of the decade, since 1896, we've never had a down one. Yeah, I mean that's looks to be an interesting year as we move forward. But the best opportunities typically come once you've had a correction into the summer and into the fall. Just look at I got a table here on the Nasdaq, and from the highs in the spring or in the first half of the year. And typically, Nasdaq's down anywhere from 11 to maybe 33%, with an average 20% decline. So from where we are right now on the Nasdaq Composite, another 10% would be the norm. And that's if that's what the Composite's going to do, some of the frothier ones are going to give up a bit more ground than that.
Yeah, sure. And, it looks to me, I mean. The market proves me wrong, but it looks to me like the Nasdaq and the Russell 2000 have been in a correction since March. And I think it's still in one, and it's just the S&P 500 and the Dow. The averages are holding up and doing well. So I think it makes people don't realize that we're actually in a correction.
Yeah, it's these internal ones that are frustrating to people because they look back on it and they haven't seen performance in the accounts because it's so few of the stocks are actually doing well, but the indices look good, and that's I've seen that numerous times over the years, and it's the frustrating part of investing.
Yeah, and what happens too is that while, everyone, if you're chasing performance, then you're in these stocks that all of a sudden now become the worst performers, and then out of nowhere, these new stocks, the money rotates into energy stocks and utilities. I mean, that seems to be what's been happening, but it just happens so suddenly. So few people are able to just make that kind of switch in the right time.
Yeah. Well, as I say, it's been that type of year, and I'm sure there will be much more in terms of rotation before this year is finished here.
Our conversation with trader Mike Swanson from WallStreetWindow.com and Ross Clark from CIBC Wood Gundy will continue next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to our special edition of This Week in Money and our conversation between trader Mike Swanson from WallStreetWindow.com and Ross Clark from CIBC Wood Gundy and how you can make money in any kind of market. Let's listen in.
Okay, from a valuation point of view, you think we're in a secular bull or a secular bear still? Where are we sitting? Any idea?
I think we're still in a secular bear market.
Yeah, I'm looking at 09 on an inflation-adjusted basis, not a BLS number, but something like a shadow stats. Sure. the pre-Clinton variety, and that the 2009 low just matches up perfectly with the support line from 1982 and 1932. Okay. So I'm thinking that this is we're trying to come out of the secular bear, and if we can hold on the correction, then to me it actually looks a lot like 1925. And if you just stop and think about the next 4 years out of 25,
what would we have to do to? I mean, how much of a correction are you talking about?
Well, a 20% move in the Dow that's the best thing that can happen. Yeah. I hate markets that go without corrections because you're looking for, like, I use 20 and 50 period moving averages, whether they're dailies, weeklies, months, it doesn't matter. And I like to look for 2 tests or 3 tests of a moving average, and then you either start to move away from that and the trend builds, or you have the deeper correction, which then allows the small clean out to let you have the next leg to the upside. And so, what I've looked at, like on the NASDAQ, this run, we haven't had a correct, this is the first time since 2000, all the way back to the 1970s, where we went this long without a correction back to the long-term moving averages. And so, in January, I put a piece out saying, hey, looks like a June low is probably in the cards, 15 to 20% below here. Because that would be stretching all of the other characteristics that I could see looking back. So if we do that, I can be happy.
Right.
So.
Well, what happens? What happens if 6 months later it doesn't do it?
Well, in like all of these, you got to have, as a technician or whatever, you have to have your line in the sand. And actually, on gold, my line in the sand is at 1262. Because if we take that out, then that doesn't qualify as a post-mania bottom for me. That means we got to go down and take out the 1180, and you got to build a whole new bottom down there, and
more time.
Yeah, and that becomes frustrating. So for now, I got my 2 parameters: support and resistance, and anything in between. It's a casino every morning when you walk in. Are we up or are we down? We roll red or black.
Right. Yeah, you're absolutely right.
Ross Clark from CIBC Wood Gundy and trader Mike Swanson will wrap up their thoughts next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to our special edition of This Week in Money, a conversation between trader Mike Swanson from WallStreetWindow.com and Ross Clark from CIBC Wood Gundy.
It's It's been an interesting conversation here, Mike.
Yeah, for sure. It's always fun to talk with someone who really knows their stuff and it really is a practitioner of technical analysis. We start out talking. I told you that one of the things that I learned from was the Stan Weinstein book, and there are a couple others too, but that was really one of the most important catalysts for me. And what's funny about technical analysis is it's really not that complicated, but I think most people are kind of intimidated by it. Maybe it's just the word itself, or just trying to learn this kind of stuff that's foreign to people. So I was kind of wondering, for me and for everyone listening too, what kind of books and work helped you form a philosophy of your trading and investing?
Yeah, well, I actually started off reading Professional Tape Reader, which was Justin Mamos's market letter, and he had been a specialist on the New York Stock Exchange, the floor there, and Weinstein ended up being his disciple, so that all of this comes around full circle to the type of analysis that has worked over time. It's that whole basis of let a market tell you what it's doing. If it sells off hard and then it starts to just consolidate and the volumes start to dry up on the downside, and you test the lows and you just can't go through them by any large degree, and then then you start to turn the corner to the upside and you take out resistance on expanding volume, and you look back and you say, okay, there was the bottom, and you try and get in early in the momentum move. And that's coming out of that stage one that you look at into stage two. And, that's, to me, that's the thing to look for. I call, I look for it as a quote sign of strength as you're breaking out. And likewise at a top, when you're rolling over through support, you're looking for that sign of weakness. And then that first bounce back after that becomes your selling opportunity. So, when I look at it at a stage one base that's complete, then you want to look and say, okay, now, how much of a pullback can you look for? And I like to work with moving averages and percentage retracements. So I'll look at a 20 and a 50-day moving average. And if the market can hold, maybe 40% of the move after a breakout and it consolidates and kisses the moving average, then that to me sets up for the next leg in the upside. And, as long as you're holding your moving averages on the corrections, then you just ride with the trend.
Yeah, one thing you mentioned is that, when you look to, say you want to short the market, you mentioned that you would basically wait for it to break down and then have a rally that fails before you did it. And that's the same philosophy I have exactly about trying to profit from a bear market. In 2008, I didn't short until I think it was August or something, and in 2000 it was, I think I restarted doing it in September. And the thing is, I get emails from people that are bearish on the market, and they ask, is it time to short, or should we short this or that? And then it is tough to try to short the stock market so you can really be sure that you're right, and it really takes that failed rally to know.
Well, you like to have the rolling top or the rounding bottom, and then you've got something in terms of a support or resistance that you're working with. And if it violates your parameters, then exit and look for something new. But trends will inevitably go further and longer than you think that are possible. Just ask the people who were long Enron for that tail end of that move on the way down. How many bottom pickers were there? So to me, I developed a few years ago some indicators that work at finding capitulation and exhaustion levels. But even at that, invariably what you get is just an initial retracement move. It's the key is how do you react after that? If you've had an exhaustion high and then you come around and you can't get back through that high and you start to roll, that's your big sign in terms of taking market action. And the same thing happens off the bottom. If you turn the corner and then you hold on the corrections. Just let the market go, and be there, but try not to second guess just how far it will go. Let it prove itself. And, I think for any of us, that's the key, is that we have these preconceived notions, in a model of what we think might happen. But that has gotten me into more trouble over the years than anything else. You're better off to just follow the market, let it show you what it's capable of doing. And once again, my name was Ross Clark. I'm with CIBC Wood Gundy, and my email address is ross.clark, that's CLARK, at CIBC.ca. And Mike, if you'd give us your information.
Yeah, sure. All people need to do to contact me is go to the website wallstreetwindow.com. It's all one word, and you can hit contact on the top nav bar and send me an email if you like.
Thanks to our guests, Ross Clark and trader Mike Swanson. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.